portfolio context then, so considering the different forms that inflation might take, and then considering, just the ambiguity about whether we're going to see material inflation in our investment horizon, just acknowledging the huge amount of uncertainty in the trajectory of economic characteristics and financial markets, and sort of scoping out a truly diversified portfolio against all these major types of market conditions. What do you think a portfolio looks like, and where does IVOL kind of sit in that? And how would you kind of think about sizing it?
So the one thing I'd say is it depends how much you hate credit. That's a weird way to start, but I think
we all loathe credit. So
loathe it.
Yeah. Loathe it. You all be big. I mean, it's funny because the more people hate credit, the more they're like, oh, I love IVOL. Like, I have CIOs call me up all the time and they're like, IVOL's 25% of my portfolio. Should I make it bigger? I was like, I don't know. I'm not, sizing is not my thing. I'm like a super specialist, but I think the investors who think defaults are going higher, credit spreads are too tight, the rally in equity and credit is just nonsensical, they tend to have IVOL as a much bigger piece of their portfolio. Some people use it just as an inflation substitute, but I can show you here. Let me share my screen with you. We have in on our IVOL website, there's our materials tab, and in here we have a presentation deck, and on page 9 and 10, we have a couple of, classes of we have a whole bunch of model builders who use IVOL. Most model builders in fixed income use the Bloomberg Barclays Ag Index. Even if they're active managers, they're benchmarked to the Ag. Mm-hmm. And the Ag is an old index. It used to be the Lehman Ag, and it has about 40% as treasuries, but it has no TIPS in it. TIPS were invented by the U.S. Treasury, the inflation-protected bonds, in the late 90s. And then about a third of it is short vol from mortgages. So we have a bunch of these passive investors who are like, look, we have no idea what's going to happen. We just want to have a diversified fixed income. And they use IVOL as a way to complete that passive fixed income exposure to give inflation expectations, and to neutralize the short vol of mortgages. So that's been pretty popular as just a, completion portfolio. We do have some, real estate people. I think of IVOL as almost like opposite of a mortgage. It's long an option in a treasury portfolio instead of an agency obligation and a short option. So some people use it as a, potential real estate hedge. It depends. Obviously, real estate's very local. Canada has been a very hot market. I do not know if it would be a good hedge in Canada or not. And then some people use it instead of having min-vol, low-vol equities. I really hate that strategy's name. They tend to be value-based stocks, and people see them as defensive because they've had historically less drawdown, but they have really nothing to do with volatility. They just happen to have a lower standard deviation of returns. And so some people use, instead of having like low vol, min vol, they'll use IVOL as a way to actually have long vol. And then on the fixed income side, we have a bunch of people that obviously replace it instead of just a TIPS portfolio.
I was wondering about that one. That seems like an obvious use case.
Yeah, it's kind of like, especially when you look at, you go back to the level of like, wow, break evens are, 231 basis points and this is 104. It's pretty obvious there to diversify away from the Bureau of Labor Statistics CPI index. And then some people use it for floating rate notes because floating rate notes are mostly credit spread risk. The coupon resets higher with interest rates, but it's not really the best. If they're worried about higher rates, it may or may not be the best thing. And then short duration has become really popular. We have a lot of people who use, they're in short duration because they're worried about higher interest rates. But the problem with short duration is still long duration, right? You are 100% guaranteeing that your investors, your clients will lose money in a higher yield environment with short duration. And a lot of the short duration strategies have gone down the rabbit hole into all sorts of credit crap. They have all sorts of, a lot of these indices have, 80% of it is credit exposure. So although it's a short duration credit, think about it, if you were a company right now, a corporate, and you needed money, would you take a short dated loan? Like, I wouldn't. I'd be turning
100-year.
myself out.
Give me the 100-year.
Yeah, it's generally the crappy credits that use short dated debt. In my opinion, that's my bias. I don't want to offend any corporates, but why wouldn't you turn it out? So you look at a lot of these floating rate. It's like short duration, and yeah, it might have a duration less than a year, but the likelihood of that thing, that Romanian bank going bankrupt, is pretty freaking high. So I think it's been pretty popular with a lot of professional fund managers, like a lot of endowments in particular, will use it as a replacement for short duration, because at least we have the potential to make money in a higher yield environment versus being guaranteed to lose money. And then going back to the credit thing, the more they don't want credit exposure, the more they look at their short duration managers and they're like, holy cow, it's 85, 86%. And they have all sorts of crazy things in there. A lot of these short duration funds will have CMBS or ABS or CLOs or European banks, all sorts of, like, in my opinion, pretty toxic stuff to own in today's environment. So hopefully
Advanced cash management, I believe, is what they call it.